Hi, welcome to a special market update with the S&P breaking a major resistance area last week. I wanted to get this out to you as soon as possible. And what we're going to be looking at now is the aforementioned S&P. Now, these are Bollinger Bands. I'm not going to go into detail on how to use Bollinger Bands, but essentially you could use them to gauge overbought and oversold. I use standard 20 period moving average and two standard deviations above and below the moving average. So you can see how nicely the Bollinger Bands work in the S&P as giving us a sense if the market's overbought, okay, or oversold. And notice here we got a bullish engulfing pattern in the oversold area, so you had a candle signal confirming a Western signal. But the market is overextended on the upside now, so a little bit of hesitation would not be bad. But as far as support is concerned, what we're going to be looking at is one of my favorite Western indicators called change of polarity. And essentially, an old resistance area, once broken, should become support. And there are nuances with change of polarity as far as also support becoming resistance, but it's beyond the scope of this session here. So for now, let's remember a multi-tested resistance area should potentially become support. So with that in mind, what I've done here, and this line should be a little closer to here, but I've drawn a resistance zone from here to over here. So this resistance zone from about 1425 maybe down to about, kind of eyeballing it here, to a 1415 level should be a support zone on any corrections. And in fact, as I mentioned before, trading laterally or even a little bit down could be helpful considering the extent of the rally that the market had late last week. So the market's still in a longer term uptrend, and the breakout is certainly a positive. A little pause that refreshes would be good, and kind of the last gasp of support would be over here. And if the market closes, I would say under the 1410 area, the risk is down to about 1390. These would be my support zones. There's a zone here, S1, support zone 1. And this to me is quite important. Support zone 2 here, and then support zone 3 here. As far as why the market may stall right around current levels, temporarily at least, I'm thinking right around the 1440 level. Let's go to a monthly chart, because we have to go back quite a few years to reach levels we haven't that we're currently at. Now notice this little rally here that we had back in 2008, and to me it's minor resistance, but nonetheless it's a chart point that many investors will be, or traders may be looking at. And if we extend it, that's where we get right around current levels, around 1440, where the market's been kind of trading laterally for the last day or two. So this to me is minor resistance right around the 1440 area. The major resistance, as far as I'm concerned, would be, see this bearish engulfing pattern, or almost a bearish engulfing pattern, the black almost wrapped around the white real body, and this little dark cloud cover here. The black candle gets more than halfway into the white candle. By the way, if you're not familiar with these basic candlestick signals, be sure to go to my website at www.candlecharts.com, and on that you'll see a link for a free candlestick glossary that gives you very basic definitions of some of the most important candlestick signals. But nonetheless, the reason that we had such a big sell-off is the reason this resistance became so pivotal is it was a candlestick signal, although not a classic bearish engulfing pattern, almost a classic bearish engulfing pattern, but you had confirmation of a prior resistance zone. So to me, the major resistance, next major resistance, is up at the, I'd say, 1555 to 1575 area. So although there's a monthly chart, I would be looking for some resistance there, even based on the daily chart. Now, a lot of us are looking, whether we trade crude or not, are looking at gas prices. So let me discuss a little about the crude market and what's going on. What I'm showing here is, this is the RSI, it's the Relative Strength Index, and it's an indicator where you can gauge overbought, oversold, and generally when it's above 70-75%, it's viewed as the market's being overbought. So notice how on this daily chart, and this is a continuation contract in crude, by the way, the market rallied, it got a little overextended. This dashed or dotted line is telling us when the market got overbought. And by trading down and then laterally, shown by this horizontal arrow, notice how the if I said oversold, I meant overbought. The market got overbought, and by trading horizontally, the overbought condition was relieved. Same thing happened recently. The market had a fairly substantial rally. It got into overbought territory, and by trading laterally for the past few weeks in what the Japanese call a box range, a lateral trading environment, the overbought condition has been relieved. So what that means is that if the market breaks above $98, it could really get moving because it's not overextended to the upside. So on a break above 98, my next major resistance would be up here at the highs made back in, it looks like April or early May, up around the 105 area. And like the change of polarity that we talked about with the S&P, if the market closes above the 98 area, this old resistance at 98, if crude is solid, should become a support level. And speaking of support, if crude closes, let's say under 93, what I'd do is take the height of this box range. So let's go from 93 to 98, so $5. Take away $5 from 93, and my downside target then would be $88. So when it close under 88, my downside target, close under 93, my downside target would be right around 88. So I hope you found this useful, and look forward working with you as we send you our next market update or our market highlights, which is our educational video sessions. Have a great day, everybody.